Annuity is actually a series of cash flows. Annuity is a series of cash flow which has certain characteristics. Number one is the constant amount. There is constant amount of each cash flow. Then there is constant interval, and then for limited or known period of time. So three characteristics there are. Annuity, constant amount. For example, they say that you will be getting 20,000 every year from next year. Yes, from year 1, 2, 3, and 4. For 4 years, you will be getting 20,000 each year. This is called an annuity, constant amount, constant interval, and for limited or known period of time. That is called an annuity. And now, annuity, there are two ways to calculate present value of cash flows. One is that, for example, cost of capital is 10%. Okay, so you apply simply present value factor, discount factor to each and calculate present value. The other is annuity. What is annuity? Annuity, through annuity, present value can be calculated. That is the annual cash flow into annuity factor. Annuity factor. And there is annuity table, which is given in your notes as well, which I have given to you people. I can show you that as well. So, and simple annuity factor. Let me show you. Where is the annuity table? Yes. Here you go. This is discount table, present value table, and this is annuity table in front of you. For example, if you calculate using discount factor, present value at 10%, present value at 10%. Here is the annuity table in front of you. You can see. Okay. So first of all, with the discount factor equal to this into 1.1, 10%. 1.1 is 10% raised to power minus this. Raised to power. Yes. So total present value of cash flows. So simple sum of all that. So we used discount factor and calculated the present value. Now through annuity factor, the present value of the same. So present value is equal to, how to calculate? Annual cash flow, that is 20,000 into annuity factor at 10% for four cash flows, 4 years. So annuity factor at 10%, annuity table you see, at 10% for 3.170 into 3.170. So you see, almost quite close. So present value of cash flows through annuity factor. Now, so the next is annuity is of three types. One is called simple annuity, where first cash flow starts from next year, which is called, not today, next year, year 1 from now. Year 1 from now. And this is what we have calculated for. Year 0 is today. So we have discussed the same example. Then is annuity due or in advance. The second type of annuity, where cash flows start from now. For example, they say that you will be given, I will take the example. The cash flows 20,000 from now, starting from now and every year. So just see here. For example, if we ignore this, what is it? Simple annuity. So present value, the formula is the same formula for it. But we know that there is year zero as well. If we ignored it, yes, we said that ignore it, it can be solved by this. But we cannot ignore it. So for year zero cash flow, we know discount factor is 1. Discount factor is always for year zero. At any discount rate, it is 1. 1 plus annuity factor. So this annuity factor is for all these 4 cash flows, which are all cash flows beyond and including year 1. For year 0, it is 1. Okay, now the discount factor is 1. So now, so present value, that is equal to annual cash flow, 20,000 into 1. This is discount factor for year 0 cash flow, plus now 1, 2, 3, 4, 4-year annuity factor. We know that that is 3.170. 3.170. And here it is. So this is present value of cash flows of annuity due, annuity in advance, delayed annuity, or deferred annuity. What it is? Delayed annuity is the case of where cash flow starts after next year. After year 1 in any year. Here in annuity, annuity due, cash flow starts from now. So, for example, so we take example that the cash flow is starting from year 3. Delayed annuity or deferred annuity. So if we forget about year 1 and 2, if we assume that this is year 1, this is year 2, okay, next, this is year 4, we assume that. So same is the way to solve it. So let us solve it. When we solve it, this is then year 0. Answer will fall here when we calculate present value using this. Let us do this. So 20,000 into 3.170, simple annuity. This 63,400 is the answer in year 2. This is the value in the terms of year 2. We need to calculate its present value today. So 2-year discount factor will be applied to it. 2-year discount factor will be applied. So 2-year discount factor at 10% same rate we have assumed. So it means into discount factor. So this will be into 1.1 raised to power minus 2. Yes. So this is the real present value. This is the real present value. So delayed annuity, the formula is that actually now that we simple annuity, answer comes 1 year back. And now we have to take to year zero by applying discount factor. That is called deferred or delayed annuity. Next. The next point is perpetuity. So perpetuity, what is perpetuity? Perpetuity is a series of cash flow. It is a series of cash flow with constant amount, constant for unlimited period of time. For foreseeable future. For unlimited period of time. That is called perpetuity. And how to calculate present value of perpetuity? For example, we say that you will be getting from year one 15,000, and every year in the foreseeable future you will be getting the same continue perpetuity. Cost of capital, for example, that is 12%. Now present value of perpetuity is equal to annual cash flow into perpetuity factor. What is perpetuity factor? That is 1 over R. What is perpetuity factor? 1 over R. So present value is equal to annual cash flow into 1 over discount rate. Here it is. So annual cash flows are 15,000 into 1 over 0.12. 1 over R. Next point. So perpetuity is of, first of all, simple perpetuity, same, which we have discussed already. That where cash flow starts next year, year one. Simple perpetuity. Then comes perpetuity, we have discussed it, the same. So perpetuity due or an advance. Perpetuity due or advance. Where cash flow starts from now. So cash flow starts from now. So year 0, 1, 2, 3, and 4, and so on. So we can say that it is starting from now, year 0, until infinity for the foreseeable future. So same, so present value of perpetuity is equal to, if we ignore year 0, it is 1 over R. Cash flow into 1 over R. But for year 0, discount rate is 1. And any, so 1 plus 1 over R. This is the perpetuity due. This year, this 1 is for year 0 cash flow. So cash flow 15,000 into 1 plus 1 by 0.12, 14,000, 140,000, sorry, perpetuity due. Delayed perpetuity. Deferred perpetuity, where cash flow starts after year one, from after next year. So, for example, this is a timeline. We say cash flow is starting from year 4, and you will be getting the same in the foreseeable future. In the foreseeable future, cost of capital is 12%. Now, if we consider it is year 1, it is simple perpetuity. Then it is year 0. Okay, then it will be year 0. So it will be simple perpetuity. One over R. So we need to take that amount to year 0. Again, discount factor for the remaining, for year 3 has been applied. So present value, same approach which we use for annuity. Present value is equal to annual cash flow into 1 over R, 0.12, 12% we have taken, into 1.12 raised to power minus 3. This is delayed perpetuity, deferred perpetuity. So we calculate, we get this present value. Now, the next point is perpetuity with growth. This has some difference now here, the basic definition. Here we assume that cash flows grow at constant rate in the foreseeable future. They grow at constant rate every year. That, for example, they say that from year 1, you will be getting 12,000, and with 5% growth annually for foreseeable future, getting dividend. Okay. For example, this is what is the present value if cost of capital is 18%? So present value can be calculated CF1, cash flow in the first year of perpetuity, divided by R minus G, growth rate. Cash flow in the first year of perpetuity, 12,000 divided by R, discount rate, 18%, minus growth rate of dividend, G, 5%. This is the present value. This is the present value of perpetuity with growth. These all annuity perpetuity has to be utilized in your multiple exam question. That's why you should have a good idea and knowledge of it and command on it as well. So the next point is, I will be doing a bit variation in the question. You are going to receive 12,000 shortly as dividend and 5% growth annually afterwards for foreseeable future. Now, the point is, you are going to receive now, shortly, not the next year. So it is current cash flow, CF not. So calculate present value of all cash flow. So just see here. So CF1 next, in the first year of perpetuity, next year, that is not given to you. So we have given CF naught here, 12,000. We need CF1. How to calculate? CF naught into 1 plus growth rate. So this formula will become, so present value is equal to CF naught into 1 plus G over R minus D. This formula will become. Both formulas you should understand and must be able to use wherever that it is given. Okay, the data. Now, so CF naught, for example, cost of capital is the same. Yes, 18%. So CF naught, 12,000 into 1 plus growth rate, 5%, over R, 18% minus growth rate, 5%. There you go. So here you go. Perpetuity with growth. Any confusion, any problem in it, you can ask. So we have discussed it already. Annuity and perpetuity. Yes. So the next topic is which we are starting today. That is risk and uncertainty in the investment appraisal. So risk and uncertainty. So what is risk? Risk is the condition where there are several possible outcomes, because yeah, project is future which you are going to launch. We are studying investment appraisal. Come back to the basics, what we are studying. Where there are several possible outcomes. And next, where probability can be assigned. Yes. Uncertainty, several possible outcomes. Probability cannot be assigned. Where probability cannot be assigned. Yes. Now, so students, uncertainty, how to deal with uncertainty. So uncertainty can be dealt with. The first is sensitivity analysis. Sensitivity analysis is the first way. Sensitivity analysis talks about, because we want to identify that what we are forecasting today, we are going to get or not. What is the risk? What is uncertain? Because project appraisal is happening today, which is related to the future. So sensitivity analysis actually, it measures that how much it is the percentage, it measures the response of NPV of uh, a project towards a change in certain variable. I will explain. That, for example, if sales fall by 5%, what will be the impact on NPV? Second, if variable cost increase by 10%, what will be the impact on NPV? Yes, another definition, that how much a certain variable should change to make NPV of the project zero. That how much it should change to make NPV of the project zero. Now, the point is how it is measured. So, sensitivity, let me open from notes as well. Yes, here it is. So, sensitivity is NPV of a project divided by post-tax present value of particular variable. Yes. For example, selling price sensitivity or sales sensitivity, same applies. So it is NPV of a project, present value of after tax sales into 100. Variable cost sensitivity, NPV over present value of after tax variable cost. Now, sales volume. So NPV over present value of after tax contribution. And you can see this. Now, with example. Let us do it with example. For example, this is a project. I will take assumed figure just to explain to you people. Sales are, for example, this into, yes, these are the sales, variable cost. Variable cost fixed cost. Fixed cost. Now, taxable cash flows. This minus this minus this. Taxable cash flows. Tax rate is 30%, same year. This into zero point 0.3, negative. Post-tax cash flows. Here we are. Now, for example, initial investment. Sorry. Yes, initial investment in the project, that is 25,000, and scrap value is 5,000. So net cash flows, sum this into this. Here we are. For example, cost of capital is 12%. So present value at the rate of 12%. This into 1.12 raised to power minus this. So NPV is equal to sum. Here it is. This is the NPV of the project. So now sensitivity. In exam, it will be like that. First of all, you need to calculate NPV normally of a project and then calculate sensitivity. I have done the same. So calculate sensitivity of the project towards, let us do one thing. Here, make it 45. Negative, oh, sorry. Mistake. There is a mistake. What is the mistake? Tell me. It should be negative. Now it's okay. Initial investment is negative. Right. So calculate sensitivity towards number one, selling price or sales. Number two, variable cost. Number three, sales volume. Number four, cost of capital. Number five, project life. So 5 different variables I have chosen. So we will learn one by one each. So we know for the time being that sensitivity, so the formula is NPV of the project divided by present value of post-tax variable. Right? Now, so first of all, we need to find selling price or sale. It is calculated in the same way. We will pick sales from here. Sales. So the first of all, 1. Now, so post-tax sales, that is 30% is the tax rate. This into 1 minus 0.3, post-tax sales. Done. Present value of post-tax sales at 12%, that is the cost of capital. Yes. This into 1.12 raised to power minus this. Present value of post-tax sales. So total. So total present value. Sum from here to here. Now applying the formula of sensitivity towards, this formula. So that is equal to NPV over sales. NPV over sales. So the answer is in front of you. How to interpret it? How to interpret it? If sales fall by 23.6%, NPV, sales or selling price? Sales or selling price. NPV of project will become 0. So in other words, this is margin of safety as well. How much safe you are. Which variable is critical? Where their small change may make NPV 0. So let us do this for variable cost as well. So variable cost, I will copy. Yes. Sorry, I need to link the cell. Okay. Variable costs are here. So variable costs are in front of you. Now how to calculate it? Post-tax variable cost at 30%. This into 1 minus 0.3, same. Post-tax variable cost. So present value of post-tax variable cost equal to this into 1.12 raised to power minus. So total present value. Total present value. Now, sensitivity. Sensitivity. NPV, present value, same formula of post-tax variable. So the answer is if variable cost increase 58.9%, NPV will become 0. Next point. The next is sales volume. It was a second. So the third is sales volume. Now for the sales volume, we need to calculate contribution. So contribution So the sales volume we need to calculate sales minus variable cost. Here we are. Sales minus variable cost. Contribution. Now post-tax contribution. This into 1 minus 0.3. So present value of post-tax contribution. This into 1 minus 0.3. Sorry, post-tax we have done. Yes. Now present value. This into 1.12 raised to power minus. Yes. Total present value. Total present value of post-tax contribution. Now, sensitivity. NPV of the project divided by this. 39.3%. What does it mean? If sales volume falls by 39.3%, NPV will become 0. So now, students, another thing I'm going to add here. Sometime examiner question asks that how many units it should fall to make project worthless. Sometimes they say like this. So, and they have given number of units annual. So annual number of units sale, I take assume that is 50,000. For example, assumption I have taken. So how many units by how many units sale should fall? That is equal to 50,000 into this. So 19,627 units, by this number of units sale falls, NP will become 0. You can see. By this number of units, the sale should fall, NPV, to make NPV 0. Next, the next point is, so sales volume is done. Cost of capital. Now for cost of capital, fourth, we need to calculate what is IRR. IRR is the rate at which NP will become 0. So from cost of capital to IRR, how much cost should increase to make NPV 0? So sensitivity equal to how much IRR minus cost of capital. This is increased. And what is the percentage increase to current cost of capital? Just see here. So we will calculate IRR of the project. IRR of the project. These are the net cash flows. IRR formula applied. 35% is the IRR. So sensitivity 35% minus 12% divided by 12%. So percentage, how much percentage? 193% if it increase, 194% cost of capital of current level, then NP will become 0. The next is, the last is project life. If there is confusion, you can ask any question. If any point you think that I was too quick, you can ask me to re-explain. I'll be happy to do that, to stop and re-explain. Now, if there is any question, you can ask, please. Now, the next point is project life. Now, project life sensitivity, how it is calculated? We know that. What is discounted payback? We know that discounted payback is the time period in which present value of initial investment is recovered only. Present value of initial investment is recovered only. Discounted payback. So what we do is in the discounted payback, if life is reduced to discounted payback, total life, that means only initial investment will be recovered, present value of investment. If life is reduced to that, so you see here, so what will be the sensitivity? That is equal to total life is how much reduction? Discounted payback of the project divided by life. Percentage, this should be the reduction. Reduction in life, percentage reduction in life to make NPV 0. Now, come here. So we will be writing it here. Just see here. So I will be picking it from here. The cash flows, present value of cash flows. But for discounted payback, we need present value of cash flows. No, we cannot write it here. Okay, I will be doing it here, 5th. So space is less here. Yes, 0, 1, 2, 3, 4. Now, so discount, so these are the cash present value of cash flows. So cumulative cash flow. This plus this. Plus this. So now, 2-year complete. And part of year 3, 2-year complete and part of year 3. How much? 7689 divided by this. So 2.79 years is the discounted payback. So sensitivity, we can calculate. Full life is 4 years. 4 minus 2.79 divided by total life, 4. So project life, if project's life is decreased by 30.3%, NPV will become 0. That is sensitivity analysis. But sensitivity analysis has certain drawbacks we should talk about. Advantages of sensitivity, not complicated. So it helps to identify that critical variable. Which are the critical variables? Which, if there are small change, and we will. So what is the critical variable here? What is the most critical variable so far? Sales 23 point, which with small change will make NPV 0. Yes, the most critical is sales right now. And of course, management has to make judgment based on it and make decisions now in that how to deal with sales to prevent it from happening. But disadvantage is that each variable is considered to be independent. One by one, we have taken each variable one by one. Now, so in practice, variables are interdependent. One cost is increasing, the other is increasing, selling price also. So interdependent they are. If in the economy, inflation is increasing, pricing increasing, cost of capital also increases. Practically, they are interdependent. So sensitivity analysis has this drawback that it considers all variables are independent, which is unrealistic. Second, very important, it tells that if sales fall by 24%, NP will become 0. But what are the chances of that fall? Probability of occurrence. It doesn't talk about that. It can say this variable is critical. If it fall by 5%, NP will become very critical. But what are the chances? Doesn't talk. Yes. Very important. Another point. That it tells us these are the critical variables. Now you have to make a decision. Now you have to make decision that what to do with it. You have to make decision. It in itself, it does not give any decision. Okay, in itself, it does not give any decision that how to tackle it. Okay, the next is critical factors may be those over which managers have no control. Because selling price may fall because of some weather change, fashion change, government taxes. So what you can do? Nothing. You can identify, okay, this may fall. Sales, sorry. Okay, so what to do with that? Or cost may increase because of the higher import duties, government taxes. You can't do anything. Of course. Now, then came the simulation model. Simulation model basically a solution to this problem that one variable at a time. Okay, so it was a solution. Okay, it catered that as well. So what this model said that it says that number of mathematical modeling, which is basic computer program, that you identify all variables and how they are interdependent as well. You see here. So first of all variables, market size, selling price, growth rate, investment, residual value, and specify the relationship between them to calculate NPV. Net cash flows, how they're calculated. Okay. So means that whatever the relationship it is, then you run the program across all probabilities level, and the solution is there. Now, so students, merits of solution simulations. It consider all possible outcomes. Now, its calculation is not part of your syllabus. Only some theoretical discussion is. It gives have multiple applications because it is very sophisticated model. It simulate everything. Demerits, complex calculation, high cost, data input gained, collection is very costly. And it forms probability distribution of all possible outcomes, statistical model it is. And of course, data accuracy, what you are collecting and what you are rendering, data, what you input, data collection, if data collected is not accurate, it will be a problem, output will not be accurate. Okay, so students, that's time for a short break of 5 to 7 minutes. I'll be back. I will start with the probability analysis. Project value at risk is the topic today. Okay, and very interesting it is. So we will be continuing with it, but in 5 to 7 minutes. Okay, thank you. Yes, students, now. Thank you for your patience. The next topic is probability analysis. Now, probability analysis is basically at expected values. That where we know that 2, 3 scenarios may occur. That, for example, probability analysis or expected value. We know that there is a chance that selling price will be either 200. It has chance that we can charge 35% chance, or it may be 350. Chance is 45%. Selling price we can charge, that is 500. Chance is only 20%. So what is the expected value? So 3 probabilities are there, and 3 options, and each has its probability of occurrence. So X, P. So Px, probability into that certain amount. So Px. And now sum of all this. This is the expected value. Sigma Px. Yes, this is the formula, sigma Px. That probability into, yes, this, and sigma Px. So, students, we can utilize, we have incorporated different probabilities, and incorporated risk, and got expected value. One value. Risk already considered. Advantages. Weighted average value. Different outcomes occurred. And a probability considered. Yes. So single figure answer, but it has drawbacks as well. Drawback is that, first of all, probabilities of each outcome is maybe based on judgment, very difficult to estimate. Now, listen. Focus. Very important point. There is 35% chance that 200 will occur. 45% chance that 350, 20% 500. There is no option of 327.5. Not a single option. This expected value is not occurring in any case. Either this will occur or this or this. This 327 will not occur. This expected value can only occurs if the same project is repeated again and again, and then weighted average of all cases, all projects will be 327.5. And it doesn't happen. Project is one of normally. They're not repeated actually. So this Assumption is a major drawback to return. Now, this is the problem with the expected value. The next point is value at risk. Students, the notes I have given to you, don't print it. A few points remaining only. I will be giving it to write. I will update. Okay. So then you can print. Okay. Just utilize it as a part of your study virtually. Project value at risk. What is value at risk? That how much a project will lose its value over time. How much? At a certain probability, yes, or confidence level. So very, very good discussion it is. Project value at risk is 100,000 at 5% probability, or 100,000 at 95% confidence level. What is the difference between the both? That there is 5% chance that a loss will exceed 100,000, or 95% chance that this means that loss will not exceed 100,000. It will not exceed. So three probability levels are used normally: 1%, 5%, and 10%. So value at risk has this formula. Value at risk, K, standard deviation, N under root. N is number of years. Standard deviation, K is the values. The value of K at 5% is this. At 1% it is this. And at 10% it is this. So you need to memorize these three values. Unfortunately, you need to. If it is tested in exam, it will not be provided to you. Okay. Now, you need to memorize these three values. The value of K. So, a project has, okay, cash flows have a standard deviation of 25,000 and life of 5 years. Calculate value at risk at 5% probability for 1 year life or for full life of project. Now, so simple, the formula. This is the formula, yes. Value at risk K, 5%, 1.645 into standard deviation 25,000 into square root for 1 year. Yes. This is the value at risk. For 1 year, and value at risk for project life. All things remaining the same, only life will be changed. 5 years. Everything will remain the same. Interpretation that at 95% confidence, the maximum value will fall over life will be this. At 95% confidence or 5% probability is that the loss will be more than this. Okay, so 5% probability. So that is the value at risk of a project. Any confusion you can ask, please. Any confusion before I proceed? Now, what is stress testing? Again, it is measurement of risk. That stress testing is you consider the worst possible outcomes. Worst possible outcomes and impact on the project. It is designed to test the sensitivity of project's value at risk under the worst set outcome that can reasonably be expected to occur. Reasonably. That for example, the worst political instability, worst inflation, what will be the impact on the project? So that is here. Now we will be proceeding towards the next topic is capital rationing. Yes, here it is. Capital rationing. This is the last topic for today. And I think it will be enough for you to absorb. Okay. So actually, I have prepared a timeline. I will be sharing that. I am updating that actually. Here you see here. This is in front of me, my course plan. Okay. So we did this in the last class. And we are just right on the track. So capital rationing is the second. In the next class, cost of equity, cost of debt, WACC, and practice will be done of the past papers. But remember that what we are discussing in the class, if we are spending 2 hours or 2.5 hours in the class, you need to spend double time at home after the class to grasp and prepare well all this. Because there are so many tiny points which you need to memorize. Okay. And you should not miss those points. Now, so what is the capital rationing? Capital rationing is a situation where funds are limited. Available positive NPV projects are so many, but funds are limited. So what is the reason of limited funds? Two reasons. Hard capital rationing and soft. Hard capital rationing when the funds limitation is from external sources, external factors. External factors which are not in the control of company. You want to issue shares, but your stock market is not valuing your shares properly. Depressed share value. Banks are not lending due to government restrictions. New funds cost is very high. Interest rates are very high. So you cannot raise funds. Okay, so hard capitalization because of the factors external to organization. Soft capitalization. Soft capitalization. Company itself has decided not to raise more funds. It doesn't want to issue shares. It feels like that control will be diluted. When you issue shares to the public, control will be diluted. EPS may dilute, earning per share. More number of shares, less profitability. So EPS will go down. It doesn't want to issue more debts. It thinks that will be high interest cost burden. Possibility is there. So their own decision not to raise debt. That is available at fair interest rates. Company wants to raise only, launch new project only using retained earnings only. Soft capital rationing. Now, so capital rationing may be for 1 year, or it may be for the number of years, multi-period capital rationing. So, for 1 year, single period capital rationing. Now, the point is, a finance manager's role is that they need to decide that they need to have the most of the available funds for the company. They need to gather, collect, generate maximum wealth for shareholders given the constraints of the funds. So single period capital, where funds limitation is for only 1 period. So single period capital rationing, when we talk about, two possibles are, for the first assumption, all projects are divisible. Case 1. Okay. There is a case 2 as well. Indivisible projects. Come here. We solve it here. So, single period, sorry. Capital rationing. Single period capital rationing, the first one is projects are divisible. Projects are indivisible. Really? Oh my God. You should have told me earlier. I am discussing other topics. Oh my God. Okay. That's okay. It's not been much time. Thank you. It's okay. So single period capital rationing. Projects are divisible. This is the, due to multiple screens. Sometimes I shared the other screen where my whole schedule is in front of me and I forgot to switch the screen. Thank you anyways. Not much time. So projects are divisible, projects are indivisible. Two possibilities are there. The purpose is to maximize wealth for shareholders. This is the objective of a finance manager, finance professional. So the point is, if projects are divisible, so the best combination of projects is selected using profitability index, and here the best combination of project is selected using trial and error method. Yes. So for example, we take example that the company has available funds 1,000 million. Okay. So available projects, investment required, and NPV. So projects available A, B, C, D. For example, four products available. Investment required is 450, 570, 380, and 700. NPV 230, 370, 190, and 440 NPV. So now, under both circumstances, if projects are divisible, then how to select a good combination? So I will solve using that. Okay. So we have to choose the best investment plan if projects are divisible. Now you see here, we will calculate profitability index, PI. What is profitability index? Is equal to NPV over investment. So NPV over investment. So now what we do ranking of the projects. Highest 1, 2, 3, and 4. So that is if projects are divisible. Now ranking has been done. Project with the highest profitability index. Now investment plan. Investment plan. So first of all, project. Which one will we choose? Yes. So available funds. And NPV earned. Now available funds are how much? 1,000. So investment plan. The first investment plan is the project with the highest profitability index. B. How much is the investment needed? This. NPV earned. Now, the remaining funds are here. The next is the term of 2. Oh, now it requires 700 investment. We have only 430. So project C, partial. That's why we say projects when they are divisible, that we can invest in the part of investment. We do not need to undertake a whole project. We need to invest in the part only. That will be okay. And we can earn part, the same proportion of NPV. So let's see here, part. Which part? This part. 430 divided by 700. We have only this amount. So 430 investment we can do. So 430 divided by 700, same proportion of NPV we will earn. Thank you. D it is. Thank you. Same proportion. So total NPV earned is here. So optimum investment plan is invest in full project B and part of project D. So optimum investment plan and NPV, total NPV earned. Here it will be with this investment plan. Partial of D. Now come towards, if it is clear, it should be clear, if projects are indivisible. Yes, I will copy once again all this data from here. Now, come here. We need to make combination. Funds limitation is 1,000. To the point is, combination. Okay. Investment required and NPV earned. Just see here. Trial and error. So lock is 1,000 investment. So combination A plus B. Investment required here. It doesn't make sense. We cannot make it. It is crossing it. A plus C. Yes. So A plus C. NPV is also added. Then B plus C. Yes, that makes sense. Within 1,000. So NPV earned is here. B plus D, no. C plus D, no. Okay. Only, so two combination possible. If we, for example, if we reduce it 380, okay, so then things will be different. Okay, so two combinations. The best combination is B plus C. The best combination for investment is B and C. And remaining 50 investment will be available to business. Remaining funds to business. They can invest somewhere else. That's how indivisible projects are dealt with. Now, the next point is, the next point is, students, single period capital rationing profitability index has some drawbacks. It can be used for development project. It does not consider variation in cash flow, of course. It does not consider size of project. It talks about profitability only, of course. Size of it, because it made decision based on this factor. Some examples are given here as well. Okay. Now, multi-period capitalization. When funds limitation is for number of years. Number of years. Funds limitation. Not only 1 year. So it is used, linear programming is used to select maximum best investment plans. How? So linear programming, it says define objective function. What is the objective? To maximize NPV. Define constraints. Define constraints. Limitations of funds. Final values. So in divisible projects, if products are divisible, you will put value 0. 0 means you cannot take any project, that project. Or 1, you will take whole project. 0 or 1 means take whole project or leave it. You cannot take part. If products are divisible, then you say you can take 0 to 1, means you can take in fraction as well. Part of that as well. Now, very good example it is. Very good example it is. This is a project A, B, and C, and D. The details are in front of you. Investments in 3 years. Investment in year 0 and year 2. Investment and investment. Funds limitation, they can invest only 40,000 in year 0 total. Try to understand. They can invest only 35,000 in year 2. And total this in year 2. 1 and 2. It is in front of. NPVs of all products are given. First of all, objective function. Maximize the NPVs. Maximum. Objective function. Maximize 20,000 of A, 27,500 of B, 15,000 of C, 10,000 of D. Maximize. This is objective function. Now constraints. What is constraint? This sum, 75,000 of A, 22,500 of B, and 12,500 of D. There is nothing in investment in C. It should not, the sum should not be greater than this. Year 1, 0, the sum should not be greater than this. 76,500. It should not be greater, should be less than or equal to 40,000. 25,000 of in year 1. A, 15,000 of C, 15,000 of D. Their sum should be equal to or less than 35,000. Yes. And the third, 10,000 of A, 30,000 of B, 20,000 of C, and this of D should be less than or equal to of 42,500. These constraints and this function is clear to you. Tell me, is it clear? Is that clear? Tell me, please. Any confusion, please ask. If it is not clear, do ask. Next. Final value. Now you will put value if you want to take, if they are indivisible, 0 or 1 value, 0 to 1 value. So put the values, yes. Now, so you will put in the system and will make a decision. Okay. Another example is here in front of you. Similar. And when they are put in the system, the results are here. That this project Y1 will be taken fully, year Y2 will be taken fully, there will be no investment over here. Okay. So if 3 and 4 are taken, they are ignored, the value will be less. Well, again, this interpretation is part of your syllabus only. This programming and the calculation through the program is not part. Simple. Interpretation is your part. Now, so capital rationing is done. Now we have 30 minutes and I don't want to leave class. I want to continue. If you say, can I start the next topic? Cost of equity, VAT, tell me, are you ready? I want to continue. Tell me, cost of equity, should I start? Tell me, please. We have time. Yes. Thank you. Just 2 minutes. I will start in just 2 minutes. Okay. Yes, everyone. So cost of equity. Cost of equity capital. How it is calculated? There are two methods. One is called dividend valuation model. The other is called capital asset pricing model. Dividend valuation model actually talks about, this is for the valuation of shares basically, this model, but we utilize it for this purpose as well. So dividend valuation model actually talks about that the market value X dividend without dividend of a share is equal to present value of its future dividends. Its future dividends. Now, the market value of a share is equal to how dividend, if D is being given for the foreseeable future, and it assumes that dividend is constant. Same dividend will be paid every year. Dividend is equal D into 1 over R, perpetuity. Foreseeable same dividend. So price of a share, that is equal to D into 1 over cost of equity. R is cost of equity here. So cost of equity, that is equal to D naught, current dividend which is being paid constantly every year, over P naught, ex-dividend price. For example, a company pays the dividend of 35 cents each year, and market value of share being traded is 470 cents. What is the cost of equity? 35 cents over 470. It is 7.44%, 45%. That is the cost of equity. That is the cost of equity. Very easy to calculate. Dividend over X dividend market value. X dividend and cum dividend, what is the difference basically? X dividend, you might be thinking. X dividend share is a price, share price. And cum dividend price. What is the difference? The difference is that, for example, a share of a company is trading at 450 cents, for example, in the market. You can go and buy share at this price. And the company announced on, yes, the company announced on 10th of August. Today, company announced that on 10th August, a dividend of 30 cents will be paid. Company has announced. So before the share was trading as this price, I'm sorry. So the price will instantly increase in the market and it will become 450 plus 30. 480 cents. This will be the price. So now this is come dividend price. That now, as soon as you buy this share, you will be entitled to 30-cent dividend on 10th August. On 10th August, and meanwhile, share price go up and down. The next, for example, it is today, 13th July, right? On 15th July, due to trading, other factor, the share price goes up. And share price becomes on 20th July 495 cents. Until 10th August morning, the share is being traded at, sorry, 495. I'm sorry. Share is being traded at 520 cents. 10th August morning. Dividend is paid, and in the evening, 30 cent paid. And in the evening, the share price, as soon as it is paid, the share price comes to 490 cents. Again, it is X dividend price. This was also X dividend price. So this was also X dividend price, X dividend price. So this price, which is being used in the formula, that is price without dividend. X dividend and cum dividend is clear, I hope so. Now, so we assume that dividend is constant. This formula assumes. Then is dividend growth model. Growth. That now this formula assumes that dividend paid by company to be increased by a constant rate every year in foreseeable future. Now, in this case, this is perpetuity with growth. For example, current dividend company paid, that is 35 cents. Price of share is, that is equal to X dividend. Yes, that is 245 cents. Now, cost of equity, we need to calculate. If dividend growth every year is by 4%. Now, this is perpetuity. So the rule is the same. The market value of share is equal to present value of future dividends. And remember, this is D1. Remember cash flow of CF1 in the perpetuity with growth. Perpetuity with growth formula, CF1 over R minus G. Perpetuity with growth formula, present value. Same will be applied here. So D1 over R is the cost of equity here, minus G. This is the price of share. Now we need cost of equity. D1 over P naught plus G. Now, the next point is D1, dividend, next dividend, not the current. And where current dividend paid? 35 cents. So D1 is equal to, we don't have D1 here, D naught into 1 plus G. The formula becomes cost of equity D naught into 1 plus G divided by P naught plus G. Now, so let us calculate 35 cents into 1 plus G, 4%, divided by P naught, 245, plus G. So cost of equity is calculated using dividend growth model. Now, students, the next point is to dividend growth. The next point is another example. A company X Limited, dividend to be paid next year, 70 cents. Current market value of share, X dividend, that is 570 cents. And afterwards, after year one, dividend will grow at 6% per annum. What is the cost of equity? So D1 over P naught, D1, next year, 70 cents over P naught. Plus G, 18.3% cost of equity. Dividend valuation model is used to, now growth rate. This growth rate G, calculation of growth rate. There are two methods. One is called historic growth model. The other is called Gordon's growth model. Gordon's growth model. Historic growth, that we will be utilizing the past trend of growth to predict future. So, historic growth, which is also called averaging. Yes, averaging. Now, for example, 20 20x2, 20x3, 20x4, 20x5, and 20x6. Dividend paid by the company is as follows. This is the dividend paid by the company per share. Now we need to calculate historic pattern to predict future. So story growth model is that dividend growth you can calculate how? Dividend latest. Dividend oldest. My wording of formula. Because I don't believe in memorization formula. I believe in application. If you know how it, why we are using it and how we are using it, you need not to memorize majority of formulas. When you have logic in your mind. Raised to power n 1 over n. Minus 1. Just see here. Latest dividend. This. First dividend, this. Raised to power. 1 by, basically square root. Now n. What is n? Number of years? No. Number of intervals. 1 interval, 2, 3, and 4. Here are 5, interval are 4. Here are 5, interval are 4. Minus 1. 7.3%. That is the historic growth model or averaging model. Next is Gordon's growth approximation model. G is equal to BR. B is the retention rate of profits. B is retention rate of profits. And R is return on investment of company. Average return on investment. For example, the company has EPS of 90 cents and dividend per share of 50 cents. Dividend per share of 50 cents. What is the retention rate? Their retained is 40. How 40 came from? Total earn is this. Paid this. Retained by company. Retention rate. We need B. 40 retained out of EPS. 40 retained out of EPS. Earning per share. R, return on investments of company, ARR. It is also called ARR. 12%, for example. So G, in this into this. So growth rate is here in front of you. Now come to the notes. cost of equity. Yes, dividend valuation model. I have discussed with you people. Golden growth as well. Yes, R is sometimes calculated as well, not given. Take profit after tax divided by equity. Okay. So students, that's it for today.